Well, welcome to another episode of Breakaway from the Rat Race. And today I have the pleasure of speaking with Josh Cantwell. Josh is used to working as a financial advisor, but in 2004 decided to change his life for the better, of course. And he was able to combine his knowledge of financial investing with real estate and to create a very successful business, which quickly grew into closing over 100 wholesale and short sales deals per year. That's hard to say. Josh now owns about 4,000 apartment units with various JV partners. Today, he focuses purely on cash flowing multifamily properties. And in 2007, also, Josh founded a strategic real estate coach, which coached thousands of investors on how to replicate his success. Josh, welcome to the show.
Hey, Eric, thanks for having me on. I've been looking forward to this for a long time since you joined me on my show. That's time flies. It's been like 6 months or 9 months since we did that interview. So thanks for having me on. I appreciate it. Looking forward to it.
I know. And we've been talking a little bit just before this interview. And, even in the last 9 months that since we last spoke, it's just a lot of things have changed. A lot of different directions. I think you've kind of like you have a different focus now, not quite different, but you have more defined focus, I would say. So tell me about that. Tell me about kind of like what it's like that right now, what kind of investment you're focusing on. And you can also talk about maybe some of the investments that you were doing before and talk about that and why you focused on the new ones.
Sure. I think COVID's an interesting time, Eric. And if you're a good business owner, if you're a good CEO, you really kind of pay attention to your business and learn a lot when you're really pushed and stressed and, challenged. I think COVID challenged everybody. And back when I look at March of 2020, at that point, we were still flipping some houses, raising money from private investors, buying properties, fix and flip. We also had a fund with about 25 million bucks in it, where we were doing private lending for both residential and commercial deals. We're also brokering some lending for other institutions. And at that time, we owned about 2,000 units of apartments. When COVID hit, I'll never forget the week that COVID hit, Eric. You probably remember it. I remember March 16th is the date. It was a Monday when the capital markets essentially froze up overnight. And to compare that to 2008, in 2008, the capital markets froze up. It took 18 months for the market to realize that banks were not liquid, that values were not there, and that people's banks' balance sheets were almost negative. And we went into the financial crisis. The same thing happened in March 16th, but it happened in one day. And so we were forced at that time to really reevaluate. I actually have a picture, Eric, probably like you, my head's down inside of my arm, because I had to make like 10,000 decisions in 10 days about staff and who we're going to keep and if we were going to keep lending. So good news, bad news. Bad news out of that is, yes, we had to let people go. Bad news out of that is we stopped doing private lending and hard money lending. Bad news is we had to wind down our fund. Good news is 18 months later, since COVID originally hit, we're exclusively and purely focused on our apartment portfolio. We bought over 950 units just this year. Between this year and last year, we acquired almost 1,500 units. And in that time, apartments have become very competitive. Values have gone up. We've liquidated and sold a couple of apartment buildings for massive, 7-figure windfalls in less than 1 year on some deals. And so today we're exclusively looking at value add apartment buildings to buy them, fix them, stabilize them, and cash flow them for the long term. So good news, bad news, you learn a lot when you're pushed, when you're stressed. And I think we've done a good job of really narrowing our business, kind of pivoting our business and being singularly focused on investments that will cash flow.
Yeah, I think the singular focus, I think that really helps. I think to at the beginning when things are going very well and stuff like that, you try to venture into different things, and everybody tried that and say, okay, well, I have something that's solid. I have a strategy that works very well, but now, I want to venture into something else. And this is something that I talk about in my book as well, is stick to with your strategy. If you find a strategy that worked and that's making money and stuff like that, then that you have like wind in your sail kind of thing,
Right.
just stick with it. If you want to then optimize it, if you have then other ideas of the strategies you want to implement, make sure that you continue or you bottle that in, and then you start something else. Of course, COVID kind of changed a lot of perspective, a lot of things, and people had to make, and everybody had to make like some pretty important decisions. But so that's kind of my thing, and I think the singular focus really helps you to optimize and then really find the best deals, and then make sure that you executing on them as best as possible.
No kidding. Yeah, no question. I think, Eric, every entrepreneur, and I've been an entrepreneur all my life. I'm 45 years old. I've never had a boss. I've been an entrepreneur for 24 years since I was 21 years old. And there's definitely the trickery of entrepreneurship, right? The devil in entrepreneurship is getting spread too thin and being over leveraged. I've been there twice. I know what it feels like. And both times was because I had a business that was very successful. I thought it was going to stay successful forever. And I thought I could almost take it for granted by starting one or two or three other businesses. Then all of a sudden, those businesses needed more time, more attention, more cash than I ever thought. And I was taking time and money from my very profitable business to put into these new ventures. And then all of a sudden, now I had 4 businesses that were all sort of failing instead of the one business that was really well.
And then you were starving the one business that was kind of doing very well. You're starving it of cash, and you couldn't do as well as possible. Yeah.
So I think, look, when we all read Rich Dad Poor Dad, when we all read, Multiple Streams of Income by Robert Allen, you go back,
wow.
Read those books.
You're the first guest that mentioned that. I actually have his book right here.
I've got it on my shelf right over there too. Multiple Streams of Income, right?
Yeah.
And you look at that and you think, well, what do we really learn from those books? It was really to own the asset, right? It was to buy the asset, own the asset, cash flow the asset, build equity, buy real estate, and wait. Buy real estate, just let it do what it's going to do. It's going to make you rich.
Yeah.
But people get caught up, just like I did, in the transactional work of wholesaling or flipping or lending, all those things, being a realtor, all those things are very transactional. And I know you and Don have done a great job of building your portfolio and really working towards cash flowing assets. One of my biggest regrets is that I didn't just keep every deal that I flipped. Right now, we've done good. We've done really well. We own a huge portfolio now. But looking back at the first, 10 years of my investing career, I flipped everything that I did. I made a big income, but I had to just, I had to get back up. My buddy, Rob Swanson, you probably know Rob, put up a post on Facebook the other day, and Rob said, look, if it doesn't cash flow, it's a job. And that really resonated with me because we've already kind of been doing that, but I've never heard somebody say it in such a short, succinct, and powerful way. If it doesn't cash flow, it's a job. And so even now, Eric, in the last really year, as we've just bought all these apartment buildings, it's interesting because I'm not working, 70 or 80 hours a week. We've got property managers, we've got commercial contractors turning units, putting in dog parks, sealing and striping driveways. There's something about doing these bigger deals that's actually easier because you have a more professional workforce, a more professional contractor base, because they know that they can dig in and focus on turning 20 units at a time instead of one rehab at a time. And if I had just worked on that sooner, I'd be further along. Now, I'm not regretting where I'm at, but the truth is that cash flow is where it's at. Owning the asset is where it's at. And for those investors that aren't doing that are still flipping, I would just challenge you. I'd say, listen, take the next year or two and be okay with making less money and at the same time acquiring more assets. And then see where you're at 2 or 3 years from now. You won't regret your decision.
Yeah, exactly. So so that's very good. So in multifamily is quite different than single family. I mean, one of those things obviously is when you add value, it's the value of the property is actually determined by the what I call the economic value. So kind of what is the net operating income, and kind of where it is in the neighborhood and stuff like that, and using the cap rate to kind of like do all of that. And so that this is very, as opposed to a single family where it is determined basically by comparable sales, which is, you know, if you're renting, it's very, it's hard to compare.
Right.
So this is the great thing about multifamily. I really like that. So there's a couple of things too. Like you have something that I think you have like a 5-step that you talk about multifamily. So how do people, if they're interested in getting into multifamily, so what are these 5 steps, or how do they get into that?
Yeah, so our business model is really based off these 5 steps. And step number 1 is really to find and buy a distressed apartment building. My focus is on buildings really between 100 and 300 units. We have assets that are larger than that, but really that 100 to 300. I would recommend somebody that's new to buying apartment buildings to start with something between 20 and 80 units. Now, it's so much easier than people think. You see, there's large commercial brokers out there. There's really 5 or 6 main shops, and I'll list those right here. There's Marcus and Millichap, Colliers International, Cushman and Wakefield, CBRE, and Newmark. Those 5 control a significant portion of the deal flow throughout the country. They're national or international shops. And what you can do is you can go to their websites right now. You can find the, let's say you're in Indiana or New Mexico, pick any state, Kansas, whatever. You can find these commercial brokers on their websites. You can go and log in and register to their back office portal on their websites, and you can immediately begin pulling down offering memorandums. Offering memorandums are essentially a packet. It's a broker packet that explains the deal. Matter of fact, Eric, I had a student, brand new student. His name is Adam. He's from Cincinnati. He's a residential investor looking to get into apartments. And in the month of August, which was last month, he pulled down 262 active offering memorandums by doing this. So that's step number 1, is to find, underwrite, and buy that distressed property. So I wouldn't have enough time to go into all the metrics.
But yeah, of course.
You want to buy that property today at a distressed value based off of what the future value is going to look like 3 or 4 years from now. So I don't really care what the cap rate is now. I don't really care how it's being managed now. What I care about is what I can make it look like 3 or 4 years from now. So we're buying a distressed property compared to the future value 3 or 4 years from now. Okay, that's step number 1. Step number 2 is to stabilize that asset by doing some significant renovations and value add improvements. And what I mean is adding dog parks, adding amenities, adding pavilions, adding park benches, better property management, and turning units, improving the building, improving the physical structure. That's the second step. The third step is we want to be all in for roughly 75%, very similar to residential, but roughly 75% of that future value. So if I can get all into a building today using very easy numbers, I'm all in for 1.5 million. I want it to be worth $2 million. Or if I'm all in for 15 million, I want it to be worth 20 million in the future. So I'm gonna be all in for 75%. Then for me, Eric, this is where we're a little bit different. We want to hold these buildings forever. So step number 4 is to refinance within 30 to 60 months and return all of the investors' capital contribution, all of their equity back to them. And we want to lock in a new permanent loan forever. Long-term financing, very favorable terms, very low interest rates. Finally, step number 5 is to simply hold that building, continue to raise the rents organically, and to have and build forever passive income and family wealth through that apartment building. And so for us, it's not about buying buildings, stabilizing them, and selling them. I hate selling buildings. Now, I've sold some for sure, but I don't like selling them. It's not like the best day ever. We just sold a building last week, made $3 million. But I'm not super excited about that because I would rather have the cash flow and the equity. I mean, what are we going to do with the 3 million? We're just going to put it into the next deal anyway. So it's not something where we're really actively looking to flip apartment buildings. It's about buying distressed, stabilizing them through significant improvements, refi and hold forever. That's what creates forever passive income. That's what creates long-term family wealth. And that's the 5-step process that we just try to do on every single building we buy.
Yeah. So, but when we're looking at this, when we're looking at the return, the annualized return on investment for that building, it doesn't look as good as when you're selling the building. If I do the right, I'm looking at it and I say, okay, well, I'm making $3 million now. Maybe it was like you may have doubled your money on that transaction. Now you can go and do it again, and then yeah, I mean it is a little bit more of a job, but you're also getting more handsomely paid for that. And
Sure. So I think it's a little bit about both. We've done 15 applications, right? We've done 15 large apartment complexes, and we've sold off 2 out of the 15 recently. And the only reason for that really is because the competition's so good, the competition's so high, it's forced values up. Money's so cheap, it's forced values up. So we decided to exit a couple of buildings and just reinvest those dollars in our next deal. But I think as a strategy, like we talked about earlier, Eric, it's important to have a specific strategy. It's important not to constantly be pinging yourself around back and forth like a ping pong ball and changing your strategy or modifying your strategy. It's important to have one backbone of your business where you're trying to make deals fit into a certain box. Yeah. You know, when I got into real estate 15, 20 years ago, everyone talked about, well, every deal is a deal. Just be a transaction engineer, be a transaction entrepreneur. Yeah. Find a way to do every deal. I do not subscribe to that strategy anymore. It's about finding the right deal because the deals are so much bigger. I only have to do 2 to 4 deals a year to create significant cash flow. So I can pick and choose the deals and make sure they fit into that box. And yes, if we didn't sell the building, you know, our investors would probably be getting a 7 to 10% preferred return, maybe some additional cash flow. But then you do have to factor in the equity, their equity position within the building, because they get equity too. So the equity is the same as the cash out. It's just on paper versus real cash, right? The return is essentially the same. It's just, did you actually realize the return and actually have the cash in your account, or is it in the form of equity? Yeah.
Okay. So basically, so what kind of renovation are you doing? Like how much of so you say that you're 75% all in when you compare to the final value or the after repair value of the property. So there's obviously a purchase price in there. How much portion of that 75% is actual rehab costs or value add?
Yeah, great question. I don't know that I have a specific percentage, but what I would say is that, look, when we go into a building, our average renovation per unit is about $5,000 to $6,000. Some units, we're doing a full turn, meaning we're spending $8,000 to $10,000, brand new kitchen, brand new bathroom, paint, carpet. Actually, no, we don't even do carpet. We do LVP, appliances and trim and all those kind of things. And then other units are more of a make ready where, you know, could be $500 to $1,000, $1,500. So it blends out. Plus we're doing some exteriors. We're doing roofs, dog parks, pavilions, ceiling and striping driveways, adding, you know, swing sets and playgrounds, you know, really improving the resident experience. And so when we look at the improvements, there are a number of things that we do to drive income and reduce expenses. And the first thing that's so important to us is to improve the resident experience. Yeah. And that means upgrading the units, upgrading the building experience, the amenities, and upgrading the management. Almost every building I've ever bought, Eric, they had terrible property managers. People that weren't returning phone calls, weren't doing maintenance repairs, trouble tickets. You know, I mean, look, you and I both know, Eric, how far paint and carpet can go. Yeah. Right. I'm blown away by how many buildings I walk, and you walk through the common spaces and they're not painted and the carpet looks like garbage and the
Yeah.
resident experience is bad when they could be spending just a few hundred or a few $1,000s on paint and carpet in the common spaces, and that immediately upgrades the resident experience, right?
Yeah.
So give an example, like one of the deals that we just bought back in April, we bought it for 11.65 million. We're putting 1.4 million into it. So we'll essentially be into it for 13 million plus our soft costs. So call it 13.5 million, all in 13.5. We're going to bump the rents from $680 up to $850. And at that $850 blended rent, that puts the value at 19 million.
Wow.
Then we'll refi, put a new loan on it, and we'll be able to cash out about $500,000 to $1 million of cash out refi proceeds. And we'll have a stabilized building all in for about 14.5 million. That's worth 19 million. It all comes down to improving the resident experience, turning the units, upgrading the building. That whole process will take us about 30 months, about 2.5 years. And look, for your audience, Eric, for my audience, if they did that one deal, it would completely change their financial life forever, right? Just one property. So that's what it comes down to, really thinking about what do the tenants need? What do the residents want in order to bump those rents? The rent, the blended rent is the number one metric in multifamily and especially large apartment buildings. What can you push the rent to? Right? Because all the other factors, they're kind of all rules of thumb, 50% expense ratio, those kind of things. So how high and how fast and how hard can you push the rent?
Yeah, it's pretty interesting. I mean, some of these, you talk about bad management. So I would also say like bad ownership sometimes too, because we bought a few apartment buildings, but they were self-managed. So we actually bought them from the owner who was managing them. Sure. And it's pretty interesting. Yeah, that's even better. Because we were walking the building with the owner, and we're just like, hey, why what if we did this and stuff like that, and what do you think we can increase the rent to and stuff like that? And he kept saying that there's no way you can increase the rent. This is what it is. This is this neighborhood and stuff like that. But what about like vinyl planks, and what about kind of like opening up the kitchen over there and then having a lighter color paint and all that? There's nothing you can do here to increase the rent. Blah, blah, blah. So we bought the building, and we made the renovations that we obviously tested a couple of units, and we were able to almost double the rent. Like the rent went from $550 to $850. Well, not quite double, but so $550 to $850, and then and now it's a little bit higher than that. But it was incredible. Like that person thought that the seller thought that this was it. That was there was no way to increase the rent, and so that's kind of interesting. And bad management is also something that you see. They don't see any point in having clean and nice amenities and all of that. But it matters. It attracts a certain group of people. You want to attract the right people that are going to pay rent. They're going to take care of the building.
The thing that I see, Eric, so often in my area. So we invest primarily now in the Midwest. We own buildings in the Atlanta submarkets, Mobile, Alabama, Oklahoma, Houston, Texas. But we're focused right now really in the Midwest. The Sun Belt, the South has so much competition. When we own buildings there, we have a 442 unit in Houston that's under contract. We're going to close on that next month. But really, again, we're still focused on the Midwest. And the reason why is every building I look at in the Midwest, especially in the Midwest, the suburbs, workforce housing, there's a theme. And the theme is laminate, carpet, brown. And what I mean by that is all of the flooring and the countertops are laminate. All of the units have carpet, and they all have brown cabinets. Well, if you think about what today's modern looks like, it's white shaker cabinets, black matted hardware. It's granite countertops or some sort of butcher block, maybe countertops. Butcher blocks are really cheap and they last a long time. They're easy to replace. And LVP flooring. Yeah. So that's a modern unit. So even when somebody says, well, we push the rents as high as we can, you're never going to get any more. that assumes that they stay in the same style of unit, which is
Yeah.
typically laminate, carpet, brown, boring, very 15, 20 years ago type of stuff. And the Midwest has a lot of this. Now, down in the South, the buildings are newer, the buildings are traded more often, they're upgraded more often. So, and there's a lot of population migration and job growth. People are moving there. So there's buildings trade more often. But look, in the Midwest, if you're looking at anywhere in Ohio, Indianapolis, Pittsburgh, Kentucky, Kansas City, these kind of areas, there's a tremendous amount of buildings that are 50 years old that have not had these significant updates done. And that allows for those kind of rent bumps that you talked about. You know, a rent bump is 700 to 900 or a rent bump 800 to 1050. That can happen when you upgrade the resident experience and upgrade the units. So that's why our focus is there versus all the other areas we've invested in the past.
Yeah, and increasing that rent is not, I wouldn't say easy, but you need to renovate, you need to update, you need to market to certain, you need to have the amenities. When you get into the other side of it, I mean, it's all about increasing the net operating income, the NOI. Going on the expense side, it's a little bit tougher to kind of like go and cut down on the expenses and kind of still maintain a good resident experience. So any tricks there on updating the or kind of like fine tuning the expense side?
Yeah, great question. That's what I was going to go. So sorry to jump in and interrupt you there, but that's exactly.
No, it's all good.
So a couple things here. So first of all, water conservation program. Older buildings are almost always going to have some leaks that you're not even aware of. So some sort of low flow program where you can come in, put in the Niagara toilets, the 0.08 toilets, a Moen faucet, new low flow aerated shower heads. That's going to come down on the water expense. So when we do a full water conservation program, you can expect that we would cut the water bill down by 25%. Wow. Now, I have a building that I'm buying right now. The water bill alone, Eric, is $400,000 a year. Oh, cut the water bill down to $300,000, save that $100,000. That $100,000 at a 6 cap is $1.66 million of value.
Yeah.
Just by doing that one water conservation program.
That's amazing.
That is a big deal. Secondly, is looking at cable and internet bill backs. Okay, when you own a big apartment building, let's say it's a 200 unit or an 80 unit, you can own the internet. You can actually pull in the fiber from the street into your building. You can own the internet. And most people in your complex are going to be using some sort of internet, and they're going to probably be paying 75 to 100 bucks a month for high-speed internet. Well, you can own the internet, bring the internet into your building. You can put in wireless nodes in a lot of different buildings up in the ceilings, especially if there's drop ceilings in your common spaces. And you can drop in internet. You can own the internet and then bill out the internet. So instead of your residents all paying 75 to 100 bucks a month, they might pay you $50 a month, but you have a $25 per unit profit.
Yeah.
So internet and cable bill backs is a second great way. The third way is to hire a utility cost consultant. And we've done this. I have a guy, his name is Josh as well, but Josh knows how to buy energy. So he'll lock in rates for gas, for electric, and also for internet and Wi-Fi. And then he'll mark those costs up slightly to us, but it's a better deal than we can get by just paying the regular gas bill, the regular electric bill, and the regular internet bill to the local providers. And by doing that, we can cut the utility costs sometimes down by 10 to 20% as well. Wow. And as you know, Eric, every nickel that we can save is an increase in our NOI. It's an increase in value.
Yeah, exactly.
So those are some quick and easy kind of things by water conservation programs, internet bill backs, and utility consultants that we've actually done in our buildings. That's worked well.
Yeah. So Josh, we're about to wrap it up. So anything you want to leave our audience with, where they can reach out to you, anything that you want to tell them, last words?
Yeah, last final words, I would say, look, there's two things. One is funding equals freedom. Funding equals freedom. If you understand how to raise private capital, and I mean true private capital, I'm not talking about from private equity funds. I'm not talking about from equity shops. I'm talking about from true private investors, mom and pops that can fund your deals. Funding equals freedom. The more of that private money you can raise, the more you can control your own deal flow. I actually got $20 million of private money right now that I need to deploy by the end of the year. So I'm looking for partners. I'm looking for deal flow. That's the first thing. The second thing is, look, own the asset, right? If you want true cash flow, you want true equity, don't be transactional. Don't flip houses anymore. Don't be a realtor. Own the asset. Let the cash flow, the things that you learned from Rich Dad, Poor Dad, and multiple streams of income, Robert Allen, all these guys that you learned from 20 years ago, implement the strategies that they talked about, right? Don't fall in love with real estate and be transactional. And with those two things said, Eric, look, the best place to reach me is just my main website. It's freelandventures.com. There they can learn about our portfolio. They can become a passive investor. They can join our Facebook group, check out our YouTube videos, all that different type of stuff. It's available at freelandventures.com.
Well, thank you, Josh. It was a pleasure speaking with you, and good luck with your acquisition next week, right?
I appreciate that, Eric. Thanks so much for having me on.
All right, take care.
Thank you for listening to Break Away from the Rat Race with your host, Eric Martel. If you want to share your story and experience with our listeners, please message us on Facebook at Break Away from the Rat Race. Also, please subscribe to our YouTube channel and our podcast on iTunes.